Happy Tuesday, everyone. Welcome to another Tax Tip Tuesday. It is absolutely beautiful outside. It's been a beautiful day. And I hope you all are having a great time, great day as well. Tonight, we're talking about something rather interesting, one that I think affects a lot of people. And it's addressing the question, well, is my income taxable? I mean, a lot of people, honestly, they don't want to pay taxes, but it is what it is. But we're gonna address the question of, is my income taxable? Right? There's so many different ways to look at this, and it's important that you understand where you stand in terms of taxability from an income tax perspective. With that being said, my name is Rose Brown, also known as the Accountant Therapist, and I am the CEO of Brown's Advisory and Accounting Firm. And of course, taxes is one of our main services that we provide, among other things, right? But ultimately, we work with individuals, businesses, the list goes on. And we are located in both Philadelphia and Atlanta, Georgia. And if you do need to reach out to us, whether that's a consultation and you just have a question from one of the videos, or hey, you found your taxes and you just don't know what to do, you can reach out to us through email at info@brownsaaf.com, or reach out to us through our website at www.brownsfca.com. Okay, and just real quick, let's recap last week. So last week I talked about the beneficial ownership information filing. So that's the BOI, right? So it's a big thing right now. And it's under the Corporate Transparency Act. But ultimately, if you are a business, or if you own a business that is registered with the state, and you have either 100% ownership, or you have some type of influence over that business, you want to make sure that this is filed, right? The due date for this was last week. So if you did not check out that video, definitely go ahead and give it an eye. If you have any business that's registered with the state, for the most part, again, that's referring to our single member LLCs, multi-member LLCs, partnerships, corporations, the list goes on. Okay. All right. So let's jump into tonight's topic. Again, we're talking about the question, or addressing the question, is my income taxable? And this is among quite a few other questions that I received throughout the year, actually. And I would say one of the many questions that I received throughout the year without fail are, and I just want to name about 4 of them. Do I have to pay taxes on my income? Or do I have to pay taxes on this income? Do I have to pay taxes at all? Is my income taxable? Do I have to report my income? And there's a short answer to each of these, but at the end of the day, it comes down to, it depends, right? First thing first, I do want to note that no one is exempt from taxes as long as you have income, unless certain rules of exemption apply to you, or the income you receive, right? So I'm going to talk about quite a bit of that. So those questions that I just mentioned, I'm going to address them, as well as provide additional details to go with it, right? So to get to help answer the question of, is my income taxable? We need to understand the different types of income, right? So there are 3 types of income. You have earned income, you have passive income, and you have portfolio income, right? So each of these have some instances where they may be fully taxable, partially taxable, or non-taxable. And the non-taxable part is pretty unusual, but it's still something that does exist. Okay. And you also want to make sure that you're keeping in mind that the federal and the states, right? The rules are not always the same. Some states follow the federal law to the T. Some have some adjustments, and some are just completely different. Okay. So you want to make sure that you're not using the state law and the federal law interchangeably. Okay. So what I'm going to do is break down these 3 types of income. Again, that's the earned income, the passive income, and a portfolio income. So when we talk about earned income, we're talking about something that you've actively been working for. You're providing your services in an exchange to be compensated. So this is the popular one of them all, right? So this is working as an employee. Maybe you're a freelancer or an independent contractor. You're pretty much literally providing your services, and you're being paid for it. Now, when we talk about earned income, there are two types of taxes that are assessed to it. So you want to make sure that you pay very close attention to this piece. So you have ordinary income taxes and self-employment taxes, or FICA taxes, right? So self-employment taxes is the same as FICA taxes. Okay. Now, everyone in the United States have to pay ordinary income taxes. Now, let me say this a different way. Every person in the United States is assessed income taxes, whether or not it's something that is a result of the different types of income, right? So as long as you're filing an income tax return, the ordinary income taxes will be assessed. Whether you need to pay it depends on which tax bracket you fall into. Okay. Now, on the flip side of that, we have the earned income that has the self-employment taxes. As long as you have earned income, for the most part, you will always have to pay self-employment taxes. Again, self-employment taxes, that's a makeup of FICA. So that's your Social Security and your Medicare. So if you're an employee and you look at your W-2, you're going to see that somewhere on there, that's going to be your box 3 and 5, right? You're going to have Medicare and Social Security, and your box, what is that, 4 and 6 is going to have taxes that are withheld. Now, this is something that's taking place throughout the year as an employee, right? But when you are self-employed, you're a freelancer, independent contractor, you oftentimes see that as a big lump sum when you file your tax return, unless you're making estimated tax payments. But ultimately, as long as you have earned income, you are subjected to ordinary income taxes and self-employment taxes. And this also includes if you are one of the owners of a partnership or a multi-member LLC. Once you receive your Schedule K-1, you will be assessed ordinary income taxes as well as self-employment taxes if you are actively participating in that partnership. So if you're providing your services and you're receiving guaranteed payments, you will see both of these types of taxes being assessed to your income. Okay. Now, earned income, for the most part, is oftentimes fully taxable. There's no true working around with that. Right. So whether it is you made a little bit, but you still had to pay self-employment taxes or FICA taxes, or you made a lot and you have to pay both ordinary income taxes and FICA taxes. Right. So that kind of covers it there for earned income. You're providing your services, someone's compensating you, and you have ordinary income taxes and self-employment taxes to pay. Now, the next piece is where a lot of people kind of sit in as well, in addition to their earned income, and this is passive income. So when you think about passive income, think about money earned with minimal effort or ongoing work. So you're not really doing much, right? And it typically starts out with you putting in initial work or investment, and the rest kind of took care of itself, right? So you're not actively involved in a day-to-day operation. Right. And typically this is derived from investments, rental properties, or royalties. Right. An example of this to kind of bring it home is rental properties. Let's say you're a landlord. That's considered passive income. Now, if you have passive ownership in let's say a company, let's say a partnership or an S corporation, and you receive a K-1, if you're not actively involved, you're a passive owner. That means you receive passive income whenever you get that Schedule K-1, right? Now, with regards to passive income, that is taxed at your regular ordinary income tax rate, which is whatever tax bracket you fall into, which currently under the current tax code, it's stemming from 10% to 37%, right? So if you are whichever tax bracket you're in, as if you have passive income, that's where you're going to fall in, and that's the tax rate that you're going to pay on that. So as with earned income, you have self-employment taxes and ordinary income taxes, but with passive income, you just have ordinary income taxes, no self-employment taxes, no FICA taxes here. Okay. Now that covers that piece there. So we're going to switch over and talk about portfolio income, which really, this is a place where a lot of people really want to be, right? So the portfolio income says, my money's working for me. And this is money generated from things like stocks, mutual funds, capital gains, dividends, interest, right? So maybe you have an online savings account with, let's say, Goldman Sachs, or, several different, maybe your credit union, right? So maybe you have an online savings account, you get interest from that. That's considered somewhat of a portfolio income, right? If you have stocks in a financial institution like Fidelity, Northwestern Mutual, you have portfolio income, right? Now, when it comes down to portfolio income, there's two major things to keep in mind. The term of the asset, which we call those items there. So you can have it be long-term or you can have it be short-term. So whenever you have long-term assets, that really means you've owned that item there, that stock, for a year and a day pretty much, right? So that means you've owned it for more than a year. Versus short term is anything less than a year, right? And it's important to understand that the time interval is critical, because the time interval will determine which tax type you will be paying, right? So when you have short-term capital gains, you will be assessed ordinary income taxes, and that's going to be based again on your tax bracket, right? So short term equals ordinary income tax. When you hold that thing there for a long period of time, a year and a day or more, you're looking at capital gains rate. And that's where truly a lot of people strive to be, because the tax rate there is so much smaller than what it is for your regular ordinary income taxes, right? So the capital gains rate is three rates there. So we have 0%, 15%, and 20%. So you can imagine if you fall within that 20% tax bracket under the capital gains, that income there will not would not result in any taxes. Okay. So this is the place that a lot of people desire to be, right? You just have money sitting, working for you, and not really doing much except for the initial investment that you made. Okay. So we talked about the earned income, we talked about passive income, and we talked about the portfolio income. Now let's talk about taxable versus non-taxable. There are some unique situations that may result in the income from that activity being taxable, partially taxable, or non-taxable. Okay. Now, when it comes on to selling your primary residence, this is a big one for a lot of people. If you're selling your home, right? So you've lived in your home and now you're deciding, you know what, I'm going to sell it. Now, the facts and circumstances of that situation is critical. When you live in your own home and you've owned it for 2 out of the last 5 years, owned and lived in it for 2 out of the last 5 years, you have access to an exclusion, right? And that's the 121 exclusion under the tax code that says if you are single and you have gain less than $250,000, that's excluded from being taxable on your tax return, but we still have to reflect it on the tax return. And if you're married, filing joint, that number raises to 500,000. But let's say you did have a gain and you're single and it's greater than that 250,000. Anything in excess of that 250,000 in gain will be taxed, right? Unfortunately, you'll get that capital gains rate. If you have a rental property, that right there is going to trigger a taxable event. So you have to record it, right? Any assets that you may even have laying around, as long as you own it, you bought it, or even if you inherited a property and you're selling it, that triggers a taxable event. So that income from there is generally taxable, right? If you're someone who, let's say you're just selling books or other products, you're just doing something small on the side, you'd be considered a sole proprietor, and ultimately you're self-employed. Therefore, you do have income that is taxable. Okay. If you're selling items on, let's say, a third-party platform like PayPal and Facebook Marketplace, Amazon, the list goes on, that is also taxable income that's resulting from those activities, right? If you are bartering, all right, so this is one of those things that are not really talked about a lot, but if you are bartering, the activities, so pretty much you're accepting something in exchange for something else. You need to know what the fair market value of that item is for the service that you're providing. So ultimately, you need to consider, hey, what would I have ordinarily sold my services for? Or that person, how much would I have ordinarily bought that for? Right. So you want to, even though you're moving products from one person to the next, you have to keep in mind what the value of those things are. Okay. Now, just a few items here that even though they are not taxable, it's still something you want to keep in mind, right? Especially as the tax code kind of changes here and there. It's important to keep in mind that non-taxable income may or may not be required to be reported on your tax return. So, for example, tax-exempt interest from a municipal bond, even though it's not taxable, it's still something that you will need to report or reflect on the tax return. If you're receiving government assistance, that's not something that you need to report on the tax return. Child support, same thing, not under the current tax code. Alimony, and this was one of those things where in the past folks did have to report it, but after December 2018, it's no longer reportable on the tax return if you were not receiving it prior to that point. Now, if you were receiving alimony prior to that period, you still have that reporting responsibility and the taxability of it. Okay. Now, if you receive a gift from someone, the value of that gift is going to determine the taxability of it, whether or not it's taxable, actually. And really, most times, if you're receiving a gift, it's the person who gives you the gift that is subjected to taxes potentially. It really does depend on how much that gift is worth, or if they're giving you money, how much is that money? All right. Now, there are some exception to taxability versus non-taxability, and one of those is going to be Social Security, right? So a lot of people receive Social Security, and there are times where it is partially taxable or non-taxable, but it's never fully taxable, which is good news, right? It's pretty fortunate there. But ultimately, if you have certain types of income on your tax return, if your income is above a certain amount, you will find yourself paying up to that 85%, paying taxes on up to 85% of your Social Security. But let's say it's just a Social Security you're receiving, you can anticipate no taxes being assessed, right? So it really does depend on, hey, outside of my Social Security, what else do I have going on? And oftentimes, if you're receiving scholarships from your school, depending on how much loan or the cost of the school is, there may not be any taxability there either. Okay, so just to kind of recap here, we talked about whether income is taxable or not, the different types of income, and what you need to consider when it comes down to the income actually being taxed, right? So we talked about the three types of income. That's earned income, that's passive income, and that's portfolio income. Each of these look a little bit different depending on who's filing the tax return, meaning, are you filing head of household? Is this joint? How much other types of income do you have on your tax return? How much of that type of income do you have on your tax return? So it really does take a lot of different things into consideration. And kind of going back to the capital gains, when you have that capital gains on your tax return, it is going to take into consideration other types of income that you have on your tax return as well. So a lot of people, whenever it comes onto capital gains and even any other type of income, if you are wise enough, you would be very strategic in how you are allowing income to show up on your tax return, and even in the year that you allow it to show up on your tax return. And this is not to say you are evading taxes, but ultimately you're being strategic about it. Because at the end of the day, the tax code is written. As long as we play by the rules and we can be very creative with it, just don't evade it, you'll be fine, right? So you just want to kind of keep that in mind. But ultimately, that concludes it for tonight. And I hope you all have a great night. And I will see you next week for another Tax Tip Tuesday Live. Again, my name is Rose Brown, also known as the Accountant Therapist, and I will see you next time.